everyone. Okay, so you're welcome to
Good evening, sir.
Yeah, good
Good
evening.
evening, sir.
Yeah,
Good
good
evening,
evening.
sir.
Good evening.
Good evening, sir.
Good evening. So you're welcome to our revision class. So what we'll try to do is we could use two approach. It's either we just revise key topics that we have looked at, we just run through it as a form of revision, or we don't even run through those key topics. We leave those ones and we just jump to past questions and start solving past question like that. We could do that, but I'm going to do a combination of the two, which is why I'm starting the intensive today. My plan was to do Saturday and Sunday with you guys, but when I looked at it, I saw that might not be sufficient. I said, okay, let me start today. So while I use today, tomorrow to revise key topics with you, which I believe you should have read, then I would also solve a few questions and past questions with you. We just speak around it, solve the ones that we can solve, just as a form of revision for you for your exams while you're also studying. So I just want to do a combination of the two for this intensive class. So it's more like a crash class for you guys. So I've shared this material with you. Is the note I used for the online class is like my class notes that I've generated, or my working note I've generated all through the class. So it's highly summarized. It contains everything that needs to be known on all your topics, all your relevant topics. So it's really a good tool for you that you can quickly look through for key topics that you want to revise. And I've also shared that of financial reporting with you as well, which is also highly summarized. So let's get to work. So when we started, the first key topic we did was regulatory framework. For those of you that joined the FR intensive class, we already spoke on this. So, and we already established that when it comes to regulatory framework in reporting, there are regulations and there are regulatory bodies. The regulations are basically the gap, which could either be principle-based or rule-based. Of course, in Nigeria, we use a principle-based framework because we use IFRS. However, when it comes to gap, you already know that it's beyond the accounting standards. There is the company law and there is the local stock exchange listing requirements. They have asked this before. They can ask it again. Sources of gap. They can ask you to discuss these three. These are questions you don't want to miss in the exam. So, but basically, we did not pay close attention to company law and local stock exchange listing requirement. We put our 100% attention on accounting standards because that's the focus of SBR anyways. But don't forget that these two are also sources of gap in Nigeria. And company law and local stock exchange listing requirements are basically rule-based regulations. So I gave you an assignment. Then I said you should tell me the advantages and disadvantages of rule-based framework and a principle-based framework. So you should, I think those that did it, then I shared the solution with them, but it's something you need to know. Focusing on the fact that a rule-based framework has advantages in the sense that they are very clear. it's clear and it gives specific guide. And also, there are little or no loopholes in the sense that everything is detailed. Everything is detailed. And it's hard for a company to say it wants to mislead the user because rule-based framework are always detailed. It has everything that needs to be known as far as a reporting framework is concerned. Just like the company law, for example, you cannot manipulate it because everything that needs to be done is stated in each section, right? But when it comes to rule-based, then that rigidity becomes an issue, right? That's difficulty in implementation because you need to know the rules, you need to study everything before you can even get close to. I mean, these are things you need to look through and have in mind. And of course, have it in mind that the key regulatory body for financial reporting in Nigeria is FRCN, Financial Reporting Council of Nigeria. You need to know their objectives. You need to know their objectives and the departments they have, which we call directorates. We mentioned this. And you need to revise this IFRS foundation structure. It's summarized here, so you can easily identify the monitoring board, what they do, the trustee of IFRS Foundation, the objectives, the IASB in charge of IFRS, the ISSB in charge of sustainability disclosure standards, the IFRS Advisory Council. They provide advice. They are like a formal link between all these bodies and professionals in practice and the IFRS Interpretation Committee. We also mentioned steps in developing accounting standards. We itemize 4 steps here. It's worth looking at, it's worth knowing, very important. And these are basically past questions that they have asked so far on this topic. This one is looking at the reasons for regulations in Nigeria. Why is regulation necessary? Why is reporting necessary? Why does reporting needs to be regulated in Nigeria? So it's also worth noting. Of course, you will know that if there are no regulations, that means companies, management will just present the report the way they want it. So investors will be seriously misled. And it will be very difficult to compare financial report of one company with another if there are no these IAS and all that. So regulation is extremely important. So it's worth looking at. At least you need to be able to know at least 5 points on this that are itemized. And we also spoke around ethics. So for you guys, you mostly find it in your exams where they will give you a case of somebody doing the wrong thing. So I've summarized how you would usually approach the solution in the exam when it comes to ethical issues. So really, you start with referring the key participants to the fundamental principles because the issue would basically be against one of these fundamental principles. So you need to bring this up, that whatever this guy has done is against this principle. And what is luring the person, the enabler of that wrong action is the threat. Either is because he believes he will benefit or because he doesn't want to find himself wrong or he's not revealing what he has done or because somebody is threatening him to action, that he doesn't want to lose his job or something like that because he's too familiar with the party in question, or is just speaking on behalf of a related party or his company and is saying what is wrong. So the enabler of that issue, you need to bring it up, you need to identify it. And finally, you need to, of course, recommend safeguards. And the sequencing of safeguards is starting with the party involved. You escalate internally. You speak with the parties involved first. Then you go above him, depending on the party involved. So assuming is somebody like a director or an MD that is the party involved in such ethical issue. So you might want to go to the audit committee of the board. You take it above him. Then if it doesn't get resolved there, then you probably escalate externally to professional or regulatory bodies. Then ultimately you might want to um, exit such unethical organizations. So there are a series of questions that are usually mostly attached to another question in your exam, like 1B or 3B or something like that. You mostly will find it in section A under the compulsory part of the exam. It will just be there underneath one of the key questions there, giving you 5 marks, usually 5 marks for free, like that in the exam. Hopefully, if I can, something we might look at if we get there. So one of the key standard that I taught you first was share-based payments transaction. So this is a common area that you would mostly find in your exam, share-based payment. And what this standard looks at on IFRS 2 is just saying that, usually when you buy goods, you pay in cash. That's the conventional way. But what the standard looks at is that, okay, what happens if you buy goods from another party, from a counterparty, and you decide to pay with your shares, right? And you decide to pay with your shares. But the focus of IFRS 2 was where where the transaction is between employer and employee. That was the main focus. That was our focus. That okay, a situation where employer compensates its employee with share options, right? That was the real focus. And not that this standard does not cover areas where an entity consummates transactions with suppliers, with other entities, and they decide to pay through their shares or share options. Of course, it does cover it, but treatment of that is very straightforward because all they need do is this. Whatever it is they have acquired, if it's an inventory, if it's goods or service, if it's services, just debit the service, debit the expense, then credit share capital or share option reserve, depending on the instruments they intend to settle it. They are giving shares outrightly, then share capital. If they are promising to give shares in the future, then we'll be looking at something like an equity reserve or an option reserve because it is not share capital yet. So it goes to a reserve account. So at the date of maturity, when they are ready to give those shares to the counterparty, then it goes to share capital. So that's kind of straightforward. Then you find in your exam that the focus will be between employer and employee. Now, there are three types of this share-based payment transaction, as we mentioned. There's equity settled, cash settled, and there is equity or cash settled. The one that is equity settled is where the entity pays for goods or services with its equity instruments, right? The one that is cash settled is where the entity pays for goods or services with cash, okay? But the value of that cash is based on the share price of the entity, right? So in this case, we are saying that we are going to give you cash, okay? But this cash will be based on the value of our share price. So everything is still linked to the share price of the entity. And there is one that is equity or cash settled. So in this case now, they have not decided how they want to settle. So either of them can decide. Either the seller or the buyer can decide whether they want to settle in cash or in shares. So those are basically the types of share-based payment transaction that we looked at. And I looked at some key definitions from what share-based payment transactions are, which are transactions that are equity settled or cash settled, as the case may be. And we looked at equity instruments, which means shares or share option. And share option is the right given to a counterparty to buy shares at a specified date, at a specified price. And there's grant dates, which is the date where the shares-based payment transaction was agreed. The date where they agreed the share-based payment transaction. The exercise date is the date the counterparty received the shares. Vesting conditions are the conditions that must be met by the counterparty before he will get those shares, which could either be service conditions or performance conditions. And after he meets these conditions, then those options will vest. So this is when the counterparty becomes entitled to the shares. And there's usually share-based payment arrangement, which is an agreement that precedes these old transactions. And intrinsic value, which is this is exactly what makes this share-based payment attractive to the counterparty, because the exercise price is usually lower than the market price. So the intrinsic value is the difference between the market price and the exercise price. Imagine they told you that buy our shares for 5 naira, knowing fully well that the market price of our shares is 12 naira. That means the counterparty will make 7 naira immediately. You are buying something that is worth 12 naira for 5 naira. So this is why anybody wants to go into such a transaction. So usually, share-based payment transaction, if it is equity settled, you are settling with your shares. So that's why is an issue of equity reserve. Cash settled, you're settling with cash. So, but it's based on share price and the future share price movement. So that means you're owing. So it's a liability since you're still going to settle in cash. So it's a financial liability. Equity or cash, this one is the two really, is more of a compound financial instrument. So for equity settled, I said that usually it can either be measured at the fair value of the goods or services, or it can be measured at the fair value of the share option at the grant date, right? So IFRS 2 stated that equity settled share-based payment should be measured at the value of the goods or services, at the fair value of the goods or services. However, if the counterparty is an employee, which is the situation where you find in your exam, the equity share-based payment will usually be measured at the fair value of the share options at the grant dates. That's because for transactions with employee, we cannot possibly determine the fair value of the services. That's why we will usually measure it at the fair value of the goods. Sorry, at the fair value of the share options at the grant date. Now, I gave you a scenario that if a supplier provides goods of 20 million and the entity exchange its shares worth 25 million for these goods, I said, how would this be measured? Of course, since this is a transaction with a supplier, so it will be measured at the fair value of the goods or services. So we're going to measure this transaction at 20 million. If this transaction was to be with a supplier, with an employee, we will not even know the value of the goods that the employee is providing, because the employee just come to work and work for you. So what you would have, the information you would have is the fair value of what the company is giving to the employee as additional benefit. And that's the one you can actually use to measure that transaction. So it looks straightforward until you then understand the fact that when it comes to employees, which is really going to be the focus, the services employee provides to companies are usually overtime. They are usually overtime. So if the employee or the employer says, I'm going to give you, let's say 20 million worth of shares, right? If you work for me for 6 years, right? So you see, this 20 million, the key issue here is that you have to recognize it over 6 years. You will not wait until after 6 years before you recognize it in the books. You would actually spread this 20 million over 6 years. And that's the core issue under share-based payment transactions. Your ability to spread those benefits that the employer is providing to the employee over the period, over the vesting period. Let me put it that way. So I gave some scenarios to you guys. I said if an entity gives 500 options to 20 employees on the condition that they work with the entity for 5 years, the fair value of the option and the grant date is 4 naira. How would the entity measures this from year 1 to year 5? Okay, so if you look at this, the entity is giving 500 options to 20 employees. And the fair value of this is 4 naira. So what the employer is giving to the employee is share option 500 to 20 employees. And we usually would measure it at the fair value of those options at the grant dates. That's how you measure it. That's the worth. So the worth of what the employer is giving to the employee is 40,000. The core issue here is this 40,000, you are not going to wait, because they say that before the employee will get these 500 options, they must work for the employer for 5 years. You don't wait until after 5 years before you recognize this in your books. You would actually spread this 40,000 over 5 years. So in year 1, you do 40,000 divided by 5, 8,000. 8,000 go to staff costs. The other leg goes to equity reserve, right? So if nothing happens, then year 1 to 5, you will just recognize 8,000 every year. But a lot of things can change. A lot of things can change within that year. You have promised 20 employees, for example, 500 options. Let's say at the end of the year, they now told us that 500 employees leave. I said 500. 5 employees left the organization. So that means that the value of what we are giving, it would then be based on just 15 employees now, because 5 has left in year 1. So we assume that only 15 would be there to enjoy this benefit, right? So the total is 30,000. So for 5 years, we'll just recognize 6,000. every year. Every year. Again, another variation could be, let's say at the end of year one, they told us that 3 employees leave the organization, and the entity estimates that 9 employees will leave over the 5 years. This is where confusion usually arises in share-based payment questions. Scenario like this. So they gave you something like this. They gave you an equation like this. The examiner now told you that 3 employees leave, and the entity estimates that 9 employees will leave over the 5 years. Then the key question should be, okay, how many employees? Because that's the key question. The key question is, what are we giving to them? What are we giving to them? That's because you are recognizing this from the standpoint of the company. What are we giving to these people? Then, in year one, that I'm agreeing with these people. There were 20 people when I did this agreement. But at the end of year one, I saw that 3 people have left. On that basis, I now estimated that 9 people will leave over the 5 years. So when you want to report for this, you are going to report on the basis of how many employees will be left at the end of the 5 years, at the end of the fifth year. Because ultimately, right from year one, what we need you to recognize is your exposure, is your expected outflow, is what you expect, the estimate of what you would give to those employees. And since based on the information you have at hand from the end of year one, 9 people would leave in total over the 5 years. That means out of those 20 people, only 11 will be available to benefit from these options. And it is that you are going to use to get your valuation of these options right from year one. So at the end of year one, the value of what you would give at the vesting date is 22,000. So in year one, what you will recognize as expense on this transaction is just 4,400. Just 4,400. And if nothing changes, you will just be recognizing 4,400 every year. Let's look at the complete scenario. So if you look at this, they said on 4 January 2001, an entity grants 100 share options to 400 employees. And each grant is conditional upon the employee working for the entity until 31st December 2003. And I said the fair value of each share options is 20 naira. And I said during 2001, 20 employees leave, and the entity estimates that 20% of the employees will leave during the 3-year period. And they said during 2002, a further 25 leave, and the entity now estimates that 25% of the employees will leave during the 3-year period. And during 2003, a further 10 employees leave. Required, calculate the remuneration expense that will be recognized in respect of the share-based payments transactions for each of the 3-year ended 31st March 2003. Okay, so look at this scenario now. Okay, I think I have a hands up. Majibadi,
Sir.
how are you?
Fine, sir. So in this the example you just gave us now, um for 11 employees multiplied by, hello?
Yeah, you can continue. I'm with you.
Yes, 11 employees multiplied by 4 naira. I think it should be 44 naira. Right? So the 44 will now be divided by 5.
Oh, how about if you multiply by 500?
Oh, okay. Okay, you're right. Thank you, sir.
Yeah, thanks. Okay. So now looking at this, so they want us to calculate the remuneration options that will be recognized in respect of the share-based payment transaction for each of the 3 years. So now I'm giving my employees, this is the grant date, 1st January 2001. So I'm granting 100 share options to each of my 400 employees, and it's conditional upon the employees working for the entity until 31st December 2003. That means the vesting period is how many years? 1, 2, 3. That's 3 years. The fair value of the share option at the grant date is 20 naira. And that's April 2001, 20 leave, and the estimate 20 employees will leave during the 3 years. 2002, a further 25 leave, and the entity estimate 25, okay, and that, like that, like that. Now, so how much are we recognizing as expense and for each of the 3 years? So let's start with the first year. So in the first year now, the key question you should ask yourself, if you want to determine how much you're recognizing as expense in year 1, which is 2001, the key question is this, is what's the estimate of the employees that will vest? Or what's the estimate of the employees that we will give this option to at the end of the 3rd year, at the end of 2003? That's the key question that needs to be asked, or that needs to be answered by you. So who can tell me in 2001, right? In order to determine this expense, who can tell me the number of employees that will enjoy this option? Because it's on that basis we would recognize our expense.
80 sorry. 320 employees.
How did you get that?
They say 20% of the employees will leave during the 3-year period. So 20% of 400 is 80. So 400 minus 80 is 320 people enjoyed benefits at the end of the 3rd year.
Thank you very much. So, and that will be the basis of determining our expense for 2001. Good. Now, in 2002, how many employees would enjoy this benefit at the vesting date? Who can tell us that?
300 employees.
How did you get that?
That's 25% of 400. So that's 300.
No, 25% of 400 is not
100. That's 100. That's 400 minus 100. That'll be 300.
Thank you very much. Now, at the vesting date, so how many employees is vesting at the vesting date?
345.
How did you get that?
400 minus the 20 in the first year, minus the 25 in the second year, minus the 10 in the 3rd year.
Fantastic. So I hope everybody gets that, because you guys are perfectly correct. And that was what we did here. So in year 1, we did the options we promised them, multiplied by the people that will vest, multiplied by the fair value of the option at the grant date. That gives us this, and we multiply it by 1/3. Remember that this 640 is the total value that we are giving them at the vesting date. So we are trying to spread it over 3 years. So multiply by 1/3. So what goes to staff cost is this. In year 2, as you mentioned, it's 300 employees that will vest. That's the estimate of vesting times 100 times the fair value of the option at the grant date. Since this is year 2, you see this 600 is the total, is now the updated value we are giving to them. In year 1, it was 640, but now it is now updated because our estimate keeps changing. So we are multiplying it by 2/3 just for us to know as at today, the employees have worked for this 400, okay, cumulatively. But out of this 400 that they have worked for, we have already recognized 213 last year. So the remaining is what we'll recognize to P&L this year. So it's usually this minus the opening will give me this. So ultimately, this is what goes to P&L in the second year. But you see, reserve is cumulative. By the time you credit this to reserve again, remember you have already credited this to reserve in year one. So if you credit 187 again, it adds up to this 400. It adds up to this 400. So in year three, the balance, as the third speaker have mentioned, the actual people will then invest, then times 100 times 20, which gives us 690. So what goes to P&L again is 690 minus 400. So, and that's typically the idea behind equity settled transactions. And there's this one that is not really common in your exam, modifications. And so I will just jump over it because I don't see it coming again, this diet. So I don't want to spend time looking at it, both modification and cancellation, but you can take your time to actually look at it if you wish. Yeah, go ahead. Can see your hand.
Good evening, sir. Can you hear me, please?
Yes, I can hear you.
Uh, I want to ask this question on the estimates of employee that will vest. So,
Okay.
if they don't mention the total number of estimates that will vest throughout the whole period of the vesting, and they mention that the actual employee that left in year one is 5, and the company estimated 20%. So, is that when we are going to use the number that actually left and the estimates?
Okay, I get what you're saying. So let's look at this question. This question would answer your question. I get what you're saying, but I think it's something like this that would. So based on what you're saying, now if you look at this one, so we are giving 100 share acquisition rights to 500 employees on condition that they work for us for the next 2 years, 1, 2, 3, for 3 years. So look at this. During in 2001, 35 leave. So they estimated that a further 60 will leave. In 2004, 40 leave. They estimated that a further 25 will leave in 2003. And then 2003, 20 left. So even in 2003, 150 employees exercised their right, another 140 exercise. So these people were exercising really. So they give us fair value, they give us intrinsic value. Now, this is not a share option, but a share acquisition right, which shows that this is a cash settled share-based payment. It's cash settled. Now, the person that asked this question, now let's look at this together. Now, in 2001, what was the estimate of the number of employees that will vest? What do you think this would be? Knowing that 35 leave in 2001, they now estimated that a further 60 will leave in 2002 and 2003. Okay, we can try.
405.
Yeah, that's correct. 405. Yes, that's correct.
95. Yeah, okay, we will now remove it from the 500.
Yes, and then remove it from the 500 if you wish. So that's correct. So because they told us because the estimate of the total departure is 35 left and a further 60 left 2002, 2003. So the key thing is the total departure, the estimate of total departure is 95. So based on 2001, the employees that will benefit from this option, from this SAR, is just 405 based on that. And that's the basis on which we're going to calculate our expense for the year. Okay. What about 2002? How many people will enjoy investing that?
400.
400. That's correct. It's 400 because
Please, how did
35
you get
left.
the 400? Okay.
Yes. 35,
500. Mhm.
35 left in year one, 40 left in year two, and we now estimated that a further 20 will leave in year three. So based on 2022 information, estimate of total departure, the total people that will leave is the people that has actually left in year one, people that left in year two, and estimate of people that will leave in year three. So that's 100. So out of the 500, so that means only 400 will remain, right? So the difference between this one and the last one that we did was that last one we did, that one was already giving us estimate of total departure in percentage every year. So that one was a little easier and direct. But this other guy is not working in that order. He's not using that route. He's giving you systematically. So, like in year one, they told you that, okay, these people left, and they say, okay, we're now estimating that additional people will leave. So, in that wise, you need to consider people that actually left and the additional people that will leave, just so that you would get the estimate of total departure. Then you can then derive, okay, what are the people that I'm going to be giving these options to? Okay, Sarah, you can see your hand.
So if we deduct the year two from if we add year two to year one, what fair value are we going to use? Is it the present fair value? Do you understand? Like year one is 14.4 and then year two is 50. They are different fair values. So
Yeah,
if we add them all
this
together, what
cash
are we?
settled. This cash settled. So you use the fair value at each year end. That's how you measure them. Fair value at
So
each year end.
if we're using fair value at each year, why are we not adding it to year two, 40 plus 25, and then adding
So
35 to it?
so the fair value has nothing to do with the fair value has nothing to do with this one we're talking about. So the fair value is a constant factor that the examiner will give you when we are dealing with cash settled. Cash settled, you measure those options or those rights at the fair value at each reporting date. But what we're trying to determine now is how many employees will enjoy this right at vesting dates. And the only reason I'm doing this addition is because of the way this question is structured. Okay, this question is structured in a way that they are giving me people that left in the current year and people that will leave in the future years separately. Like in year one, they told me 35 employees leave in year one. They now said, even though I'm in year one, but they told me that in year two and year three, further 60 will leave. And what I need is the estimate of total departure. That I need the estimate, so which is why I added 35 plus 60 to get 95. When I get that, I can then take that away from 500 to know the number of employees, in fact, to know the estimates of the employees that will vest. And those are the people that I believe, based on 2001 information, that will enjoy this right. In 2002 again, which is the second year, they told me that 40 people leave. They now estimated that a further 25 will leave. Right? So if I want to get the estimate of total departure in year 2, when I say total departure from year 1 to year 3, so I would recalculate everything again in year 2. I would say, okay, how many people left? 35 people already left in year 1. 40 people is leaving in year 2. An additional 25 will leave in year 3. And that gives me the estimate of total departure. I take that away from 500. I know that only 400 will enjoy this right. So in 2003 now, which is the vesting date, who can tell me what is the... So how many employees will vest in 2003?
So it will be 35 plus 40 plus 22. She will have left. This figure 35 plus 40 and 22 has left. It's confirmed that they have left.
Okay,
So
that's correct. So how many employees are now remaining?
403 employees remain, sir.
That's correct. 403 employees will vest. Okay, I think most of you understand it. So if you don't understand it, talk. This is how you find it in here, and they could structure it in any way. So Oluchi is saying that cash-based share-based payment deal with amounts at the vesting period. I don't seem to understand your question. But I mean, for cash settled, when you want to measure this right, when you determine the value of the right, you are going to be multiplying it by the fair value of those rights at the end of the vesting period, at the reporting date. Unlike equity settled, where it is measured at the fair value of the option at the grant date. That one is a constant, doesn't change. Doesn't change. So this you use at each year. So if you look at this, based on what you have said, in 2001, the option we are giving to them, the employee that will vest at the vesting date times the fair value of the option at the end of year 1. So this is the value of the entire right. We multiply by 1/3 because that's the vesting period. So P&L liability. So you need to remember that for cash settled, the other leg should go to liability. The other leg should go to liability. Okay, yeah, doing.
Hello, good evening, sir. Okay, so I understand this share session, right? But the question we treated just before the equity settled, I'm trying to compare both and I'm finding it confusing because I realize that what we have something like 35 leave, then 20% will leave. We're not treating it in the same way we treated this. Like, for instance, if you could go up a little bit, sorry, please. Okay, for like doing 20x1, 35. Okay, yes. Yes, doing 20x1, 20%, sorry, 20 employees leave and 20% will leave. So thinking as comparing it with share position, right, I just say 20% of 400 employees, then we now add the 20 that leave. That's getting it confusing, sir. Thank you.
Okay, so you should not get it confused. So they are not they are structured in a different way. And if you look at this one, they said 20 employees leave, and they estimate that 20% of the employees will leave during the 3-year period. Okay, so for the structure, the way they structure this question, they could structure that one to this way. It doesn't matter whether it's cash settled or equity, it doesn't matter. So, but the point is that this already gives us the estimate of total departure, this 20%. So this 20% has already encompassed this 20, is already inside. Okay. These 20 employees that live in year one, it has already been captured with this, it has already been captured here. It has already been captured here, so which is why we're not adding it again. So the 20% of 400 already gives you estimate of total departure. The same thing in year two. They said the further 20 leave, and now they estimate 25% of the employees will leave during the 3-year period. So this 25% already tells you the estimate of total departure. So this is more direct because it makes it easy. It gives the examiner just gives you the estimate of total departure. It's different from this, the way this particular one is structured, where they didn't give you estimate of total departure, but they told you that 35 leave. They only estimated the additions that will leave in the future. The additions that will leave in the future alone. So in order to get the estimate of total departure for the entire 3 years, which is why we said, okay, 60 plus 35. It's unlike the previous one. They said 20% are the people that will leave over the 3 years. If the examiner has structured this question and say that during 2001, 35 lived, they now estimated that 60 will live over the 3 years. That means this 60 has already encompassed this 35. So because that is what I need. What's the estimate of people that will live over the period? If they tell me it's 60, then fine. That means the people that would enjoy this right at the vesting date based on year one estimates is 540. But the way they structured this is they said they estimated that a further 60 will leave in the future during 2002 and 2003. So for me to get estimate of total departure, I will need to do, okay, how many people left in one? That one I know. Plus the people that will live in the future, which is the 60. The same thing in year two. 40 left in year two. And now they're estimating that further 25 will leave in just 2003 alone. So I need estimate of total departure, right? So which is why I then, okay, the 25 that will leave in the future plus the 40 that left this year plus the 35 that actually left last year, because those ones I know them actually, so I can work with the actual. Then the one I don't know, they already gave me the estimate. So that gives me estimate of total departure. It's different from that last question. That one, even in year two, they gave us, they said 25% will leave over the 3 years, which is why I'm using that as the overriding basis, because that's the only thing that points me to the estimate of total departure, nothing else. And 22 left in year three. So I can then, now I know all the actuals, 35, 40, 22, like that. I hope that helps you really. So yeah, and somebody was asking, is the vesting period the same thing as the vesting date? No. So like in this question, and the vesting date is 31st of December. That's the vesting date. The vesting period is 3 years. That's the period that they need to work with us before they can get these benefits. So for equities, for cash settled, you need to remember that they are usually measured at the fair value of the option at
Hello,
the
sir.
at the reporting date. Yeah, Oluchi,
Good evening, sir.
good evening.
Oh, my question is reporting date same as vesting date?
No. It is not. Reporting date is each year end. So reporting date for 2001 is the end of 2001. Reporting date for 2002 is the end of 2002, like that. But vesting date is the date in which the right or the options will be given to the employees. That's the vesting date. In this case, it's 31st December 2003, like that. Hope that answers your
Okay.
question.
Thank you,
Okay.
sir.
Yeah. So cash settled are usually measured at the fair value of those options at each reporting date. It's measured at each reporting date, right? Okay. And just similar methodology. So you can actually take your time to look at this question and see that you are able to tackle it. Okay. So hopefully tomorrow when we are doing our intensive, I'll be able to come back and revise a question on deferred tax with you. I think we're supposed to mention it, we did not. And I saw that in your pilot, it was not even there, but notwithstanding, something that is worth looking at. Okay, so another one was IAS 19, employee benefits. So for employee benefits, we have seen that the examiner mostly tests post-employment benefits, right? The examiner mostly tests post-employment benefits. And when it tests this, that means that's what we should really focus on then, because when it comes to employee benefits, it's majorly it's really focused on the consideration the employer gives to the employee for their effort, for their work, either the work they do immediately, which is the short-term employee benefits, and then they give them as they are paying, as they are working, they pay them, or the one that they have been keeping for them through pension, that they will start paying to them when they retire, or based on Nigerian law, when they are 50, can start having access to your pension. So for short-term employee benefits, the accounting is rather straightforward because the accrual basis of accounting is quite easy because we can be recognizing this expense, these benefits we are giving to our employees every month by just debiting staff cost and crediting bank. If we have not paid the employee, we just credit accruals, right? We credit accruals. So where complexity might arise are things, benefits like leave allowance, and maybe profit share or bonus, because those ones we might not be sure whether we'll pay the employee or not. But the overriding basis for example, profit share, for example, now, as soon as you're sure that we are going to pay the employee, as soon as we have met our profit targets, right? You as an accountant, you need to accrue for that benefits. You need to debit staff costs and credit accruals, right? Either at the end or from the date when you're certain that to be paid. And another one is if there is leave and we pay leave allowance, and depending on the agreement you have with your employees, if the leave is in such that if they don't take leave this year, we are still going to pay them this leave allowance. They can carry this leave forward. We are still going to pay them. That means you should accrue for that leave at the end of the year, since we are still going to pay it. But you need to pay attention to, is there any change to how much we are going to then pay in the future? If there will be changes to that, then it is that we would pay in the future that you should recognize in your books as a liability, because that becomes the overriding liability at that point in time. And that's what we should pay attention to. But if the leave is such that if the employee does not take it, if it does not take the leave this year, he will not get any allowance. So in such cases, you should not even accrue for any liability if the employee does not take the leave, since the money is gone. Since the money is gone. So we don't need to bother recognizing that. And that's basically the technicalities around short-term employee benefit. And I can remember giving this scenario, this question in class. I said, if you have Plyman Co. that has 100 employees, and each is entitled to 5 working days of paid sick leave for each year, and unused sick leave can be carried forward for 1 year. He said sick leave is taken on a LIFO basis, first out of the current year entitlement and then out of any balance brought forward. Then I said, as at 31st December 2008, the average unused entitlement is 2 days per employees. Plyman Co. expects, based on past experience, which is expected to continue, that 92 employees will take 5 days or less sick leave in 2009. The remaining 8 employees will take an average of 6.5 days. Okay, so a lot of things is mentioned. But now, the question says, how would you account for the unused sick leave as at 31st December 2008? Now, the key thing is this. We have 100 employees. Each of them takes 5 days sick leave every year, right? And I said, any sick leave you don't take, the principle is that in their company, in this company, is that they can carry it forward to next year. Okay? And I said that, okay, even if you carry it forward to next year, it's on a LIFO basis. It's on a LIFO basis. That means first, you're going to take the current year first before you take the one you're bringing forward. In the sense that if you have, let's say this 2025, and you don't take your leave in 2025, you say you can carry it forward to 2026, right? But in 2026, you need to take 2026 leave first before you can then take that of 2025. So first out of the current year entitlement and then out of any balance go forward. Fine. And then I said in 2008, at least each employees did not use 2 days. So, and based on past experience, which is expected to continue, 92 employees will take 5 days or less in 2009, and the remaining 8 employees will take an average of 6.5 days each. So now, this is where the whole thing is. So as far as 2008 is concerned, this company clearly has a liability. All right, clearly has a liability that we need to accrue for, because each employee didn't take 2 days. And if you look at the number of employees we have is 100. But if you just say, okay, what's our liability? And we say, okay, 2 times 100 employees times how much we are going to pay them per day, will be wrong. It will be wrong, right? And that's because based on experience, they have seen that out of those 100 employees, 92 will take 5 days in 2009, right? Meaning that based on experience, we are saying that in 2009, which is in the future, 92 are not going to take those 2 unused leave. That means there is no point, since they won't take it, we won't pay them, right? That's the policy of this company. So that means we don't have to accrue for that, because 92 would take 5 days. And remember, 5 days means the 5 days for 2009, because it's on a, they do LIFO. You need to take 2009 before you can then take the one you're bringing forward. So 92 will not take these 2 days. So as at this year, 2008, we are estimating that 92 employees will not even take these 2 days that they did not use. So there is no need to accrue for that. We don't have liability for that. It's only the remaining 8 people that will take an average of 6.5 days next year. In fact, the remaining 8 people, after they have taken this 6.5 days, means that the 5 days they have in 2009, they will now take, okay, out of their 2 days unused, they will only take 1.5 days. And that's what you should accrue for in 2008. That 8 employees will only take 1.5 days. And if you do 8 times 1.5, that's 12 days. That's 12 days. And that's the answer. They didn't give us the rate per day, so we cannot possibly determine the monetary value. But that's the main thing, understanding what liability we have. And that's the core of short-term employee benefits. Now, for post-employment benefits, which is the one you would most often than not find in your exam, is the one where the benefits actually comes in when the employee retires. And again, how do you then account for these benefits? How do you account for it in your books? How do you account for it? So what concerns the organization is the expense, is the liability they have. That's what concerns them. What's my expense? What's my liability? Now, and what determines the expense and liability is the nature of the plan they have entered into. So the way post-employment benefit works is that employers usually enters into a savings plan, a pension plan for their staffs. And based on the substance of that plan, IAS 19 categorized those plans into 2. It said it's either a defined contribution plan or a defined benefit plan. It is a defined contribution plan where the nature of the plan is such that all the employer needs to do is to make regular contributions to a plan. And that is all they do. Make regular contributions to a plan. And after they have made that regular contribution, they don't have any further obligation to that. They don't have any further obligation to that employee. They just do regular contribution, and that's all. So their concern is, okay, let me just pay pension. Let me just pay a regular pension, and that is it. And that is it. They call that defined contribution plan. So the employer is not exposed to anything that would happen to the money. So all they do is just to make contribution to a savings plan, which we call PFAs in Nigeria. So as soon as whatever those ones do with the money, yeah, is between the employee and those people. However, there are some employer that they don't do that they go beyond just making regular contribution. They make regular contribution, but they have assured the employee a defined benefit at retirement. They have assured the employee that when you retire, be sure that you will not get anything lower than your current salary. They have assured him a benefit, and we call that defined benefit plan. And that then triggers how we account for these transactions under employment benefit. For defined contribution plan, because the nature is such that all the employer does is just to make contributions, and that's the only liability they have, those contributions. So it becomes very straightforward to account for. Every month or whenever the pension is due to be contributed, you debit expense, you credit liability. If you don't delay it, you won't even have to credit liability at any point in time because all you do is just to credit bank. Okay, so you could find the question in the exam where they want to twist it. They can tell you maybe they overpaid, they did a prepayment, they underpaid, something like that. That's very, very, very straightforward. And they have asked it before for 8 marks. So something you can easily tackle. That is extremely straightforward. Now, the one that is also straightforward is for the defined benefit plan. For that, because the employer has committed itself to a defined benefit, to a specified benefit for the employee. That means the obligation the employer has is beyond that monthly contribution. The obligation the employer has is now towards that ultimate benefit. And in order to make it easy for us to account for, the standard recommended an approach called projected unit credit method in such a way that if the guy is able to work for 30 years for us, then that means with us, he will be able to get that thing we have promised. If he doesn't work up to that, that means he might not get up to that. So they graduate our obligation. They graduate our obligation. So it's something that would be graduating every year. Graduating every year. So let me show you the sequence. And in the exam, is like the way it's done in practice. It's usually an actuary that does all the valuations, that gives us all the figures that needs to be given. And all we just need to do is just for us to account for it. And what are the figures that would be given to us? Number one is I've established that, yes, we use what we call projected unit credit method. So the first thing they will give you in the exam is current service costs, which is equivalent to annual pension expense. So this is equivalent to that, okay, this guy has worked for year one, so we owe him this amount in year. So they will give you an amount for that. So that current service cost go to P&L. Then you'll be accumulating it every year to a liability account, which you call PV of defined benefit obligation. You are going to be cumulative. So every year, in fact, this is what builds up the obligation. This is where we can find how much we owe the employee. So that goes to show that if this guy works for 5 years, if people work for 5 years, that means at the end of 5 years, you would be finding 500 million in this PV of defined benefits obligation. Another thing you'll be given is contributions. So of course, you would also be making contributions to a PFA, and organizations that use defined benefits plan would go beyond just those voluntary, compulsory contribution of 1810, of 810. They also invest in real estate, insurance plans, stocks, and all of that, just so that they can meet up with what they have promised their employee. So you find out that these contributions in your books, you debit plan asset to credit bank. That's how it works. And as you move on through time, there might be changes. There might be changes as a result of maybe the company is doing well or the company is doing badly, which can result in changes in those obligations, right? If it's a situation where the company is doing well and they decide to introduce some new plan or scheme, we call that an amendment. So it will result in change in the obligation. That change in obligation, we call it past service costs. But if it's a situation where the company is not doing so well and they decide to cancel existing plan, we call that a curtailment. So that there will be a change in obligation also. That change in obligation as a result of curtailment is also a past service cost. So this past service cost, depending on whether it is an amendment or a curtailment, will determine where you are taking it to in the P&L. So if it's an amendment where obligation is increasing, where we are introducing a new plan, we simply debit P&L and credit the present value of defined benefit obligation. But if it's a scenario where we are canceling out some plans, in that case, our obligation will be reducing. We debit defined benefit obligation and credit P&L. And when people start leaving and we start paying benefits, of course, it's not like we'll start looking for the cash because we have been making contributions. So we'll credit plan assets. We'll settle the obligations from the plan asset and would simply debit the present value of defined benefit obligation. Also, whenever there is a curtailment, it usually results in a gain or loss on settlement, which is usually the difference between the settlement price, which is what we are settling with our plan assets, and the actual obligation that we owe. So the difference is usually gain or loss on settlement that we simply take to P&L. So all you need to know is this. I summarized it for you in this schedule when it comes to post-employment benefits, because this is what they will ask you in the exam. So everything ultimately comes down to it affects the plan assets, the present value of defined benefit obligation, and the nets. So you would have opening balances if it's not your first year. And the first thing you need to remember to do in the exam is these interests, because most of these figures are present value. They are discounted to present value. So usually, anytime we discount, we would usually unwind the discount using interest. So we just apply 10% on the opening figures. Then current service cost that is given to you, just come and add it to the obligation. That's what builds up the obligation. Contribution given to you, add it to plan assets. That's what builds up your plan assets. Knowing fully well that past service cost is just changes in obligation, either due to amendment or curtailment. So you simply, depending on the direction of the correction, you adjust it in your PV of DBO. Then any benefits paid will be taken out from the plan assets and the PV of DBO. And when we have a gain or loss on settlements, that would also be taken out from these two because it's settlement. So it's the difference between these two that you take to P&L as gain or loss. Now, when you determine this and you cumulate these two together, you get a carrying amount. The examiner will also give you the fair value of the plan assets and the fair value of the DBO. The examiner would always give you these two as well. So when you do your table, you must as well compare this fair value with the carrying amount. For plan assets, the difference between these two, we call it return on plan assets. It usually goes to OCI. So of course, if the fair value is higher, that's a gain because we are talking about an asset. It will be positive. If it is lower, it's a loss, to be negative. The difference between the fair value of DBO and the carrying amount, we call it actuarial gain or loss. If the fair value of the obligation is higher, that's a loss because your obligation is higher. It's definitely a loss. But if the fair value of the obligation is lower, that's a gain. Take it to OCI. And ultimately, what you take to your statement of financial position is the difference between these two. The difference between these two, between this fair value of plan assets and the fair value of obligation, goes to your statement of financial position. Okay, I can see your hands up. You can go ahead with your question, please.
Please, can you hear me?
Yes, I can hear you now.
Okay, this past service cost and gain or loss on settlement. I'm a little bit confused. So the past service cost is changes due to curtailment or amendment. But then is that not what gives rise to the gain or loss on settlement?
So what gives rise to gain or loss on settlements is just curtailment.
Okay.
Okay. Is just curtailment, right? That's what. So it's not, they are really different. So past service cost is more focused on the changes in obligation that can arise as a result of the two. Okay, the changes in obligation. So either the obligation increases. So in the exam, really, what you would find as for this is usually amendment. It's common for amendment. If the examiner wants to ask you that, okay, they are introducing a new plan, and for that reason, our obligation is increased by 50 million. So that's past service cost.
Okay.
But
Thank you.
gain or loss on settlement is when that one is curtailment. You want to settle. Then you then compare the assets with the obligation, because gain or loss on settlement. Okay, so majorly, this is basically everything you need to know. As soon as you can figure out that, then that's all for this. So in P&L, the net interest, current service cost, past service cost, gain or loss on settlement goes to P&L. Then return on plan asset and actual loss or gain goes to OCI. Then difference between those two goes to statement of financial position, meaning the differences between these fair values. And I know we saw quite a number of questions. Yes, Oluchi.
Please, I want to ask This past service course, do you charge interest on it? Because I solved one past question where they charged interest, like additional interest on the past service cost.
So it depends on how the question is structured. So you should not. I also saw that question, and I know that what they did was wrong. So if is a situation whereby where interest usually comes in, that interest you're seeing there is just unwinding of discount. Just unwinding of discount. So which is what accounts for this particular one here. So that interest they were charging again on past service costs is just double counting because this has already accounted for it, right? So this past service cost here is just changes in the obligation. So what they are looking at is that for us to recognize this past service cost this year, because that changes in obligation is a future change. It's not something it's not an expense for today. Then they are saying, okay, let's unwind the discount. I mean, they're just going totally out of it. So don't do that. Don't charge separate interest on past service costs. I also saw it and it was quite strange when I saw their solution. So good question, Oluche. It shows that you're reading. So just do your interest on this opening, right? And this past service cost, don't charge for that interest on it again. No, just use what they have given you. Hopefully, when we are going through past questions, when you are scanning through past questions, we'll be able to speak on that very quickly. So I was going to talk on this. You're welcome. I was going to speak on this. So if you look at this guy, okay, so he has 3,000 employees. And okay, so he uses defined contribution plan. And they make annual pension of 28,000. So in 2016, they paid 150 million, 119 and 54 in 2017 and 18 respectively. I mean, this is 10 max. So how should you account for this? So the examiner already told me that, okay, this is a defined contribution plan. And that already points me that the only obligation they have is towards making regular contribution. And I know that they have 3,000 employees and the annual contribution is 28,000 per employee. So first, I will establish how much they need to pay every year, which is 3,000 times 28,000. So I know that they need to pay 84 million every year. That's the obligation every year. So in year one, they paid 150 million. That means there's a prepayment of how much? That's 150 minus 84. There's a prepayment of how much? 66 million. So the first thing I will do is for me to do a schedule because the examiner wants me to account for this in the financial statements. So the first thing I'll do is I'll do a schedule. Now, okay, this is my liability for the year. That one is constant, 84 million every year. How much they paid? They paid 150. Balance, 66. And you know that 66, it will be carried forward. I'll bring it forward. I will say, okay, 66 from last year. How much this year? 84. How much did they pay in this current year? 119. I will get a balance again. I will take that forward. Then this is what I'm talking about. So this is the expense for the year 84. 2016, I know that pension cost is 84. They paid 150. That means there's a prepayment of 66. I carry that forward. Pension cost 84. They paid 119, right? they are still having a prepayment of 109 because they already overpaid 66 last year, overpaid 566. They paid 84 again. They paid they pay 119 again. And what they are owing is just 84. So they overpaid again. Carry that forward. They paid additional 54, right? All they are owing is just 84. So prepayment by. So in my P&L, what goes to P&L is just the pension expense, which is the 84, 84, 84. That's what goes to P&L. In my statement of financial position, I just account for the prepayments under my, put it as current assets. Prepayments, 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 like that. And that's, this ends you 10 marks. And another one is, there is this company, they have a fair value of defined benefit plan valued at 1.1 million. And the fair value of DBO is 1.25 at the beginning. They received a contribution of 490. They paid out benefit of 190. Current service cost 360. Discount rate 6%. Then they give you the fair value of this asset at the end, both the plan asset and the obligation. This is how you find it in the exam. I don't seem to understand your point. Okay, so yeah, when you have questions like this, just do your schedule. Just come up with your schedule. At the beginning, put your figures at the beginning. Opening, assets, 1.1. Obligation, 1.2. The first thing you must always do, you do your interest so that you won't forget. So 6% of 1.1, 66. 6% of 1.2, 75. The difference is what goes to P&L, which is 9,000. You make contributions. They made contribution of 490. You add that to plan assets. They paid out benefits of 190. You take it away from the two. Current service costs, you add it to PV of DBO, and that's it. Then you cumulate them, that gives you carrying amounts. They give us fair value of the asset and the liability. The difference between the two is what goes to your statement of financial position. In this case, the obligation is higher. So this becomes a net obligation. And I will go to non-current liability. Then you then turn to the difference between this fair value and the carrying amount. The fair value is higher. That's a gain. You call it return on plan assets. Even if it is a loss, it will still be called return on plan asset. For the DBO, the difference is 58,600. In this case, the fair value of the obligation is higher. That's a loss. Our obligation is higher. Of course, it still goes to OCI. And my statement, this 9,000 net interest goes to P&L. This current service cost goes to P&L. That's all that goes to P&L. 34 and 58 goes to OCI. 53 goes to statement of financial position. And that is how we distributed it. They gave you another scenario. They gave us the opening obligation, opening assets. They gave us current service costs, benefit paid, contribution paid, PV of obligation, PV of plan assets. And they gave us some additional information. Here, there is a curtailment because a division was sold and employees needs to be sent away. So their pension entitlement was transferred to their new employers. The fair value that we transferred was 48. The liability that was cancelled out is 50. There is a gain for us as an organization. This is what we call gain on settlement. We transferred an asset of 48 to cancel out a liability of 50. Again, the organization decided to make a one-off payment to former employees, right? And this payment was not even in the original terms of the scheme. So there is a change in obligation. So it's increased our obligation. This is a past service cost. This is a past service cost. There's an additional obligation for the organization. So again, the same thing. You draw up your schedule. You just position these things very well. Start with your opening. Immediately you are doing your interests. Position your current service costs under your obligation. Benefit paid will be taken out from the two. Contribution paid will be added to the assets. You get a carrying amount, which you're going to compare with the fair value. Then the difference between these two, which is 50, is what goes to statement of financial position. In this case, the assets, fair value of the assets is higher. We get fair value of, that's net assets to go under non-current assets. Then you compare this fair value against this carrying amount. This is an income because the asset is higher. This is 80. The obligation is higher, so it's a loss, it's an actuarial loss. In year two, the same thing I've explained before, except the fact that now the interest is now, we have a net interest because the fair value of the closing balance in the previous year is what becomes the opening balance here. By the time we charge your interest on them, you'll see that the interest for the assets is higher than the interest on the obligation. So in this case, we'll be having a net interest income. So in P&L, it comes in as an income, as a finance income. Then current service cost under DBO, benefit paid, you take it out from the two, contribution paid added to assets, and that gain or loss on settlement is taken out from the two. So we settled 48 with an obligation that is 50. So we saved 2. It's a gain on settlement. It's a savings of 2 for us. And they are taking away this 48 from this 1450 because the question told us that these settlements that we made was determined after this fair value was determined. So they have not adjusted for it. That was why we need to adjust for it. Since we are taking it away in determining the carrying amount, so we need to take it away from the fair value. So we did the same thing for the obligation too. So our net is this minus this. So the 16 is higher. So this is a net obligation, a net defined benefit obligation that goes under non-current liability. And the return on plan assets, which is the difference between fair value and the carrying amount. Fair value is higher. So we have 95. Higher amount, it's an income. The fair value of the obligation is higher, is also a loss. And the same thing in year 3 too. The only addition is the fact that this past service cost happened in year 3 and is an addition to our obligation. Every other principle remains the same. So this question completely zeroes in on everything you need to know. If you can solve this question okay for your exams. The last one I taught you, asset ceiling, they don't ask it. They won't ask it, seriously. So, but you can go through it at your leisure time if you wish, but just really focused on being able to master this. And it was then your pilot, you likely going to find it in your exam. So know it very well and you'll be fine. And there are some questions I actually gave you here for you to practice. So I want to believe every
So
one
which
of you.
pilot?
Sorry, again?
Which one did you say you found in our pilot test?
IS 19.
All right, sir. Thank
I
you.
will actually review that pilot questions with you before your most likely over the weekend.
Yeah, sir.
Just
Please
look at the
do
questions. Yeah,
do
we'll look at. So
better.
I want to believe that every one of you joined that FR revision class. So, and I've already revised financial instruments with you there. So, which means I won't have to, because it's almost the same thing with those guys. It's almost the same thing.
That it was the same thing. Everything. Even the questions were the same.
Yeah. So the only difference is just this impairment of financial assets that you need to master. So usually when you have financial assets, they can impair. And when they impair, we'd use expected credit loss to recognize them in our books. And what this really looks at is that we don't wait until we lose the money. We expect that we might lose the money. And why this is relevant in this case is the fact that financial assets is more like a money that is sure, right? Is a contractual right to receive cash, right? Or probably you invest in shares of another company. So it's money that is sure. So can you lose it? Yes. When you lose it, can you sue the person? Yes, you can, but that does not mean you get your money back. So IFRS 9 came up with expected credit loss, right? Even though the money is certain that you will get it, but I mean, expect that you might lose it depending on the condition of the issuer, depending on the condition of the borrower. Then that will determine how you account for your ECL. So majorly, the financial assets that ECL applies to, right, is financial asset at amortized cost, financial asset at fair value through OCI, lease receivable, contract asset, and trade receivable. Meaning that when you have financial asset at fair value through POL, you don't impair those ones. They are not impaired. So there are two levels or types of ECL. There's the 12 months and there's the lifetime, right? And the meaning for 12 months ECL is that you're saying there's a possibility that a default event would happen within 12 months. Lifetime is possibility that default events would happen over the lifetime of the financial asset. And when do you recognize 12 months and when do you recognize lifetime? It depends on the stage of that financial asset. There are three stages. If it is at stage 1, this is when you just originate the financial assets or when you just acquired or invested. So at origination, you should classify the financial asset to stage 1. And you are going to recognize a 12-month ECL. Your interest income on that financial asset can still be calculated on the gross carrying amount. So whatever estimate you make of this ECL, it won't affect the interest income you are going to recognize in your books. Because, I mean, the loss does not really exist anyways. You are just being prudent. You're just being prudent as an accountant that you are. And that's why you're recognizing it. So stage 1. Now, stage 2, this is where, I mean, the standard requires at the end of the year, you need to check whether there's a significant increase in credit risk. So you put the financial assets to stage 2 where there is an increase in significant credit risk, meaning that the borrower, the issuer, is under distress, either directly or indirectly. It could be the environment in which the entity operates is under stress. The macroeconomic environment of that entity, in which of the country in which the entity operates, is unfavorable, that it might affect his ability to pay you. So that your financial assets, you need to categorize it and classify it as stage 2 because there's an increase in significant credit risk. At that point, the impairment loss you make is a lifetime ECL. You call it lifetime ECL. Stage 3 is where there is now evidence of credit impairment, that the guy has defaulted. He did not pay as at when due. You classify him as stage 2, as stage 3. Though you still recognize the lifetime ECL, but the rates is bigger. So really for your exams, this is all you need to know. And as stage 3, interest income will now be calculated on net carrying amounts, meaning after deduction of the impairment. These ones that I later taught you is just for me to really explain how this thing works. They will not get to this level, how we calculate ECL model in real life, because all of this one is just highly theoretical, which is what they were asking in your exams anyways. So all this probability of default, loan given default, exposure at defaults, you can save yourself the stress for your exams. They won't ask it. So I gave quite a number of examples that I solved for you, just for you to visualize. Because if I could teach you this and just stop, but it's too theoretical for me. Just wanted you to see how it works in real life, how we actually calculate it in real life. I think I'm not sure I remember to show you sample financial statements to show you how they classify it and all that, how they get those figures. That was what I tried to demonstrate here. There's even a simpler one, which is relating to trade receivables. And that one, they still use age analysis to do that, and they will allocate provisions. Is similar to provisions for doubtful debt. They will just estimate a rate for every number of days that it remains unpaid. That will determine the impairment loss you would make, like that. I think we solved some questions like that all through. So that's for impairment of financial assets. Another interesting one was fair value measurements. And for fair value measurements, you need to know the definition, the amount received to sell or paid to transfer a liability in an orderly transaction between market participants at the measurement dates. We identified the 4 key elements when it comes to fair value. The exit price. Fair value is about exit price. When you want to get a fair value of an asset, is you just look into, okay, how much will I sell these assets? If you want to get the fair value of a liability, you look at how much will I use to settle. Yeah, look, that's exits. Fair value is about exit prices. Not only that, you can only determine fair value in an orderly transaction. Cannot be a forced sale. The buyers and the seller must understand the market. The asset or liability must be marketed before it is eventually sold. So everybody must have knowledge of the assets. That's an orderly transaction. And fair value can only be determined when the transactions are consummated between market participants, people that are willing and knowledgeable about the assets. And fair value is determined at a measurement date. Is a continuous determination. Fair value changes on a daily basis. It's a measurement date determination. So that's the first thing we identified. Secondly, I identify the assumptions that are made by market participants in determining fair value. Number one is they assume that fair value is determined in a principal market. And principal market is the market that has the highest volume of that assets and liabilities happening. If you don't have a principal market, fair value can only be determined in the most advantageous market. And the most advantageous market is the market that yields the highest amount of value or benefits to the entity. It's the market where you can get the maximum selling price for the asset. That is the fair value. And market participants wants to maximize their benefits. And also the fair value of a non-financial asset is based on its highest and best use. So when you are considering fair value of a physical asset like building, like furniture and fittings, when you want to get fair value of those items, it's majorly based on what is the best and highest use for these assets, which use gives us the highest benefit. And it is on that basis we get the fair value. And this use in question must be a use that is financially feasible, physically possible, and legally permissible. So when it comes to non-financial assets, we consider what's the highest and best use to get. Is different from financial asset that you'll be looking for markets, principal market, most advantageous market. For non-financial assets, it doesn't work that way because in most instances, those markets might not even exist. So you need to look internally to know what's the highest and best use of this asset. If I'm using this asset, what's the benefit I can get from it? And that's the fair value. And we talked about valuation techniques and approaches, which is what is basically used in practice to get fair value. It's either you are using income approach, cost approach, or market approach. They can ask you to explain each of these in the exam for 4 marks. So income approach is where you determine fair value by getting the present value of future cash flows. Cost approach is where you look at fair value as the replacement cost of the assets. Market approach is where you see it as the selling price of a similar asset. So you're using market information. And in determining your 5 valuation techniques, you need to consider the fair value hierarchy. That's what are the inputs, this fair value hierarchy will ultimately tell you the best approach. Like level 1, which is the inputs we want you to use we call them observable inputs. And this uses market prices of an identical asset in an active market to determine fair value, which is what market approach uses. Market prices of identical assets in an active market. That's level 1 input. Is this the most reliable because it uses verifiable, observable inputs. Level 2, this one also uses market prices of a similar asset in an active market. And level 2 would happen if the asset in question is not listed, is not on an active market. So to now get the fair value of these assets, you need to look for a similar asset. So, and a typical example is when you want to value your equity instruments, your investments, your shares. Let's say you have shares of Glo, for example. You now want to value it. You can't use level 1 because Glo is not a listed entity. So you can't use market prices of an identical asset. You are level 2. You can only use level 2, where you would be using market prices of a similar asset. I mean, like MTN, like Excel. But this input will require adjustments because we are using price of a similar asset. You cannot just take it to client and sync. You need to make some few adjustments. But what we are concerned about is not your ability to make adjustments, no, is understanding the input that we use in level 2, which is the market price of a similar asset. And level 3, this uses the internal information of the company. See, we call it unobservable input. This input is not reliable because you are using budgets or forecast or cash flow data. That's what you're using internal information of the company. We believe this is not a reliable basis for determining fair value. But I mean, if that's the only option open to you, you have no choice than to just resort to that. And can remember we did quite a number of scenarios just to drive home our points and be able to go through every one of that. But you have this material with the background I've given to you. You can carefully look at it. And these are kind of questions you would find in the exam. These are typical ones we have found so far, where they will give you the prices in markets. So you are supposed to determine which one is the principal market, which in this case now you can't get the principal market because we don't know the one that has the highest volume. They didn't give us the highest volume. If we're able to determine that, we can know which of the market is the principal market. And our fair value is just the selling price minus the transport costs in that market. When we want to get fair value, we don't deduct transaction costs because we believe transaction costs, they are not characteristics of the assets. They are characteristics of the market. So when you want to get fair value of an asset, you don't deduct transaction costs. It's more of a market determined costs. It's not specific to the assets, unlike transaction costs, unlike transport costs. So this is a past question. I can ask you to discuss why fair value is more relevant. Of course, it is more relevant because is It is updated. It's better for decision making. You can use it to even predict the future and all of that. Okay, somebody's trying to ask a question, but I don't seem to get what you're trying to ask. You're saying
Okay,
advantageous
so
market. Yeah.
you said when we're getting the fair value that we should just do fair value minus transport cost. So I'm
Yes.
saying, is it for when we're determining the fair value of the most advantageous market, or when we're determining fair value in general?
When we are determining fair value in general, we do that.
Okay.
So yeah. And really, fair value is primarily determined in the principal market, not the most advantageous market. It's when you don't have a principal market that you resort to most advantageous. Like in this question, they ask you this diet. After they have asked, now you should explain this input 1, input 2, input 3. So you really need to master this theoretical part. They are very important. Look at it giving 6 marks. The calculation is just 4 marks, and they even want you to discuss, not to even do any form of calculation. They said discuss. So here now they give us the volume. I mean, here now, which market is the principal market? Is there anyone that can tell me?
A, sir. Market A.
Market A.
Yes, sir. The volume of market in units is 12 million.
Exactly. So which one is the most advantageous market?
C.
C, sir. Market C, because the price per unit in market A is 2 naira.
No,
It's the high
that is not the basis.
transaction cost per unit. Okay. Uh,
Is the most is C, because it gives the highest yield, it gives the highest use, or it gives you the highest profit rather. Let me use the word profit.
Yes, yes,
Or
yes,
So
yes.
when you do
contribution.
22 minus, yes, 22 minus 3 minus 2 will give you
Correct,
17, and that's high.
correct. That's absolutely correct. And that's higher for whatever you can get for AM. So it gives you the highest profit. By the time you take away or contribution, whatever you name, but the highest benefit. So 22 minus 3 minus 2, that's 18. That's 17. This one is 14. Not even 14, 12. This one is 16. So this is still the highest. So this is the most advantageous market. So when the examiner says discuss, you are supposed to don't just calculate. Look at the way we actually solved it here. We discussed. Actually discussed. I didn't just do calculation. I said to determine the fair value, we need to identify the principal market. From the question, the principal market is market A because it has the highest level of activity. Therefore, the fair value is 17, which is selling price minus cost of entering the market. Okay, 19 minus 2. I did not deduct transaction cost. You don't deduct transaction cost in determining fair value. And I said, however, if the principal market cannot be determined, we will use the most advantageous market to determine the fair value. From the correction, the most advantageous market is market C because it gives the highest return of 17 naira. Therefore, using market C, the fair value is 19 naira, which is selling price minus transport costs. And what's transport costs?
Cost of entering the market.
I said transport cost. Supposed to be cost of entering the market, which is 3 naira.
It's
So,
true now.
and that's 19 naira. We don't deduct transaction cost in determining fair value. And there was this other question that talks about a company that is based in Abeokuta, and it uses evaluation model for its non-current assets. And this company has several plots of land which are unproductive. So the company feels that the land would be more valuable if it were used for residential purposes. And there are several potential purchasers for the land, but planning permission has not yet been granted by the Abeokuta Planning Authority for use of the land for residential purposes. Nora said, however, preliminary inquiries with the planning authority seems to indicate that the planning permission may be granted. Additionally, the Ogun State government has recently indicated that some agricultural land should be used for residential purposes. Advise Kantala Limited on how to measure the fair value of the land. Okay, 2 marks. So they wanted to measure the fair value of the land. And I've told you that land is a non-financial asset. When you want to measure the fair value of a non-financial asset, you use the highest and best use. And what are the uses for which this land can be used for? From here, it can be used for agricultural purposes, which is currently unproductive. And it can be used for residential purposes, which is what has more value. But do they have planning permission? They don't have it yet. It has not been granted, but they say they will grant it. They said they will grant it. So if I want to advise this guy, I will advise him to determine the fair value based on the residential use. So provided that this residential use is financially feasible, physically possible, and legally permissible, then the fair value should be based on the benefit you will get from using it for residential purposes. And that is 2 marks, so you don't want to waste too much time on this. So you see, I just used 3 paragraphs, each sentence per paragraph, to really resolve this question. So highest and best use. And there was this past question, I think last diet or thereabouts, that say you should discuss, not even calculate, discuss with relevant computation. Okay, you do some calculations. How this company should determine fair value of the asset and liabilities under IFRS 13. So this one also, they give us market A, market B, market C. Of course, the principal market is market A. You know how to determine the most advantageous market. But this particular company, so is trying to evaluation of assets in line with, so okay, this company trades in market C. So in addition, they said he has acquired an entity in June, and it is required to fair value the commissioning liability. So this is information of assets. They give us market A and B. In addition to that, you want to determine fair value of the decommissioning liability. And the entity has to decommission a mine at the end of its useful life. Okay. So Indomitable has determined that it will use evaluation technique to measure the fair value of the liability. If Indomitable were allowed to transfer the liability to another market participant, then the following data will be used. So they give us, for the decommissioning liability, they give us the cost of the land, labor and material, overhead, third-party costs, annual inflation, risk adjustment, risk-free. So all of this is just for the liability. This one up here is for the assets. So to determine fair value of the assets, it's just 95 minus cost of entering the market. That gives me the fair value of the asset. For fair value of the decommissioning liability, these are the costs we incur. So you'll probably be looking at the labor cost, add this 30%, add this markup, add inflation. Then you need to consider the risk adjustments also. you need to also consider the risk-free and the non-performance risk as well. Let me show you. So I explained for the assets here. Then for the liability, I also did the workings here as well. I added labor and material, the overhead, the markup costs. Then using these inflation rates, we discounted it. We got the future value because that is when it will be incurred. Then we adjusted it for risk for us to get the future value. Then the fair value, we discounted it back to present value to get the present value of our liability. So a lot of adjustments to be made. I'm sure how many marks is it? It's 12 marks. So even if you cannot perfectly do all of this, which you might, by the time you explain that of assets, you know that you are supposed to add all of these costs together, the labor, the overhead, the markup, then you compound since there is inflation every year, and also the risk adjustments. Those will give you future value. Then by the time you discount it to present value, you would get your fair value like that. So all these are just revising all of these things with you. So I'll stop here for tonight. Just looking through all of these past questions. So you can also be going through this. You would help yourself greatly if you can use this summarized material for your revision. Those guys with our online class, they're already very familiar with this. So tomorrow, as soon as I get to income tax, I would teach you deferred tax implication. As soon as I teach you this, I would also speak on deferred tax implication of share-based payments, right? So I will just speak to it, right? Just for us to, I mean, you'll be able to quickly relate like that when I get to my revision on that tomorrow. So I'll just stop here for tonight. Then we'll continue tomorrow. Wherever we stop tomorrow, then over the weekend, we will then look at your pilot questions, and let's see where that would actually take us. So it's already almost 11. Thank you very much. I wish you best of luck. I'll see you guys tomorrow.
Thank you so much, Mr.
Thank you, sir.
Thank you. Good night.
Good night.
Thank you, everyone.